When you file bankruptcy, you're required to make a payment into your bankruptcy estate each month based on your income. I'm Doug Hoyes, a licensed insolvency trustee with Hoyes Michaelis & Associates. Today I'm going to explain a Canadian bankruptcy concept called surplus income. This is an important topic because it will affect how much your bankruptcy will cost and how long you'll be bankrupt. Bankruptcy in Canada is based on the principle that the more you make, the more you have to repay your creditors. This makes sense when you think about it. Someone making $150,000 a year should have to pay more to eliminate their debts through bankruptcy than someone who makes, say, $30,000 a year. To do this, the government sets a limit on what they think you and your family need to cover your necessary living expenses. These limits change every year with inflation, but the idea is a simple one. If your monthly income, less certain allowable expenses, is above this limit, the government says you have to pay 1/2 of the amount you're over the limit into your bankruptcy as a surplus income penalty. How does your trustee know what your income is? While you're bankrupt, you'll send your trustee proof of your income and expenses each month. You'll send in copies of your pay stubs and proof of any other income and receipts for things like medical expenses, childcare costs, and support payments you make. And your trustee will calculate how much you're required to pay. The more you're over the limit, the more you pay, but it's not just about the money. Surplus income is actually a two-part penalty. Not only do you have to pay more if you earn over the limit, but you will also be bankrupt longer. You can watch our video on how long your bankruptcy will last, but for a first-time bankrupt, if you have surplus income, your bankruptcy will be extended for an extra year, from the minimum 9 months to 21 months. And if you're a second-time bankrupt with surplus income, your bankruptcy is also extended by a year, from the minimum 2 years to 3 years. So if you have surplus income, you will make higher bankruptcy payments and make those payments for a lot longer. This can make the cost of bankruptcy very expensive. Is there a way to avoid the surplus income penalty? Yes, file a consumer proposal. Before you file bankruptcy, you'll have a free consultation with your trustee. Be honest with them about how much you think your income will be during your bankruptcy. Tell them everything, because it's not just about your regular paycheck, but also includes any commissions or bonuses you may receive. With full information, your trustee can help you estimate your potential surplus income payments while you're bankrupt. If you think you will have surplus income, you could take what you expect to pay in surplus income over a 21-month bankruptcy and offer a consumer proposal where you make payments to your creditors over up to 60 months. Your creditors will expect you to offer a little extra in a proposal as compared to a bankruptcy, but you're happy because the monthly cost to eliminate your debts is much more affordable. Surplus income is complicated and can be costly, so you need to understand it fully when considering bankruptcy. Make sure you discuss anything that can affect your expected income with your trustee as part of the consultation process so that you can make an informed decision about whether bankruptcy is the right option for you.